Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 stocks to consider buying right now to help fight possible stagflation that's coming. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. All right, so before we jump into the 3 stocks to buy to fight possible stagflation, I want to quickly go over the market and some of the economic indicators that are leading people to think about stagflation. So I'm recording this Thursday afternoon, and at the moment, the Nasdaq's down around 1%, the S&P 500 is down around 0.75%. And so far, the first 4 sessions of the week have been somewhat mixed, and this followed a pretty subdued 4-session week last week with that Memorial Day shortened trading week that saw the S&P 500 slide around 1%, and this came after the market soared about 6% in the final week of May, the final full week of May, to end that 7-week losing streak. So the market comeback and the recent sideways movement came despite mounting recession fears and 40-year high inflation, and the near-term outlook for the economy is now more mixed than ever, with consumers still spending even as their overall sentiment falls to decade lows. So we saw retailers continue to struggle with inventory imbalances. Target, once again, earlier this week, made headlines for the second time in less than a month, saying it's struggling to adapt to these post-pandemic shopping patterns. And they're going to have to do a lot of discounting and order cancellations in order to get back to having the right amount of the correct goods on its shelves. And then the big factor this week is going to be Friday morning with that May CPI report. It's going to likely prove really pivotal in the near term as investors attempt to gauge the ability of those U.S. consumers to continue spending. And so right now, the CPI is supposed to come in at 8.2%, which would mark a slight slowdown from April's 8.3%, but still remain roughly right at 40-year highs. The Fed's core CPI, which excludes the more volatile food and energy, is expected to be about 5.9% compared to 6.2% in April. And this comes ahead of their next open market committee meeting, which is on June 14th and 15th, so the middle of next week, where they're expected to raise their rates by 50 basis points, so half a percentage point this time, and then they're expected to do that again in July. And if we don't see signs of inflation at least slowing down, the Fed might have even more pressure to ramp up its tightening efforts, which would then send the stock market likely lower. So Friday is going to be a big report. That's why we've seen some kind of sideways trading over the last few weeks. And then earlier this week, we saw Treasury Secretary Janet Yellen and the World Bank both worry about the possibility of inflation remaining elevated for the foreseeable future. The World Bank also on Tuesday lowered its global growth outlook to 2.9% in 2022, down from about 6% in 2021. This also marks a sharp drop from the same group's January forecast for this year, which called for 4.1% growth. And the president of the World Bank told reporters that he was worried about the possibility of stagflation, which is essentially a period of slow economic growth and higher inflation, which was really rampant in the 70s. So people were worried about the possibility of that. That's a really dreaded word in the economy and the market. So given all of these unknowns and mounting recession fears, it's probably not the best time to jump right back into growth stocks and technology names, but investors are still pouring money into the market despite all these unknowns, because there are few options to keep pace with rising prices at the moment. So if you're a longer term investor and you want to consider some ways to possibly beat some stagflation, we're going to look at some dividend paying stocks from areas of the economy that are poised to continue to outperform in the near term as tech's decade-long run of dominance slows amid the rising interest rates and current economic unknowns. The first stock we're going to look at today is Enterprise Products Partners, LP, which trades on the ticker EPD. Enterprise Products Partners is one of the largest publicly traded master limited partnerships and a leading North American provider of midstream energy services to producers and consumers of natural gas liquids, crude oil, and other refined products and petrochemicals. So the oil and gas industry is usually divided into those three major components of upstream, midstream, and downstream. So EPD is in that midstream market, which is transportation and storage of crude. So that's the business they're in. Enterprise Products Partners boasts an extensive networks of pipelines that spreads more than 50,000 miles and connects every major U.S. shale play. It has a massive storage capacity of 260 million barrels of liquids and 14 billion cubic feet of natural gas. The company said that almost 80% of its pipeline contracts with shippers have been extended for 15 to 20 years, which will help generate steady cash flow going forward. The company is also well positioned to generate additional cash flow from under construction growth projects worth $4.6 billion. So if we look over the last decade, the company's gone through some lean years, which is expected. Energy had a rough decade prior to the last several years, but they're coming off a massive year of growth. Last year, they posted about 50% revenue growth that saw the company pull in about $41 billion. And then if we look ahead to 2022, we're calling for another 20% growth to get all the way up to about $49 billion. And then another 6% plus growth in 2023 to climb above $52 billion. And then in the bottom line, we're calling for another 14% adjusted earnings growth this year, and then another 6% down the line. And the company's earnings revisions have trended heavily upward. So the company's FY 2022 estimates up about 8% in the last 60 days, with its 2023 estimate up about 6% as the company provided upbeat guidance after its first quarter earnings release. The company is also paying a pretty impressive dividend. Its dividend's yielding about 6.7% at the moment, which roughly matches its industry and blows away the 10-year U.S. Treasury and the 30-year U.S. Treasury, which are both actually hovering right around 3% to 3.1% at the moment. And that positive earnings revision helps the company grab a Zacks rank number one strong buy at the moment. It also is part of that oil and gas production pipeline space, which is in the top 13% of over 250 Zacks industries at the moment. And then Wall Street also remains really high in the stock. So of the 10 brokerage recommendations that Zacks has, 8 of those are coming in at strong buys with nothing below a hold. And then in terms of the stock price movement, just to put everything into broader context, because if you're considering holding this as a part of a longer term portfolio, obviously the last decade was not great for energy, but EPD stock is up about 2,500% over the last 25 years, which crushes its broader industry's 700% climb. So the stock's up really big over the last 25 years. And this also outpaces the S&P 500's 920% run. So if you're a long-term holder of these stocks for decades and decades, these energy plays are good or look better than they have just if you were holding in the last 5 years or so. And then if we look in the last 2 years, the company's up about 60% versus the market's 30% climb, and it matches its industry. Obviously, if we look over the past 5 years and 10 years, as I said, it's lagged. But if we look over a longer scope, in a more recent scope, it's doing very, very well. So it's up about 33% in 2022 versus the S&P 500's 16% fall. And some investors might also appreciate the fact that it's trading for less than $30 a share. So it's a relatively lower price stock. It's trading at around $28 per share at the moment. And despite its climb, it's trading at a big discount to its decade-long highs from back in 2014 and about 50% below those levels. And this is in terms of valuation. So it's trading at 11.6 times forward 12-month earnings at the moment. So this marks a discount, as I said, to its highs, and also marks a slight discount to its highly ranked industry at the moment. So overall, if you're looking for a stock to consider as part of a diversified portfolio, this could be a nice energy play with an impressive dividend yield. And people are projecting that oil prices could reach $150 a barrel this summer amid everything that's going on. So certainly worth considering in the near term as well as a longer term play. The next stock up we're going to look at is Hannon Armstrong Sustainable Infrastructure, which trades on the ticker HASI. So Hannon Armstrong Sustainable Infrastructure is a sustainable energy REIT, and the firm boasts that it's the first U.S. public company solely dedicated to investments in climate solutions, providing capital to assets developed by leading companies in the energy efficiency, renewable energy, and other sustainable infrastructure markets. The company makes loans backed by its clean energy assets like solar and wind farms. Those assets, meanwhile, are generally backed by longer-term contracts, so there's pretty good visibility on the REIT's likelihood of being paid back. The firm closed $331 million worth of investments in the first quarter of 2022, which was up from about $188 million in the same period of 2021. Overall, its portfolio grew 28% year over year to about $3.7 billion, and the company has roughly 280 investments across 10 asset classes at the moment. If we're looking ahead to its projected growth, the company is expected to do about 32% revenue growth this year, and then another 17% growth next year. And then the bottom line, we're calling for about 6% growth this year, and then another 10% growth next year. So some stable top and bottom line movement. We also have seen some positive earnings revisions since its last report, and the company has been able to pretty easily beat our bottom line estimates in 3 out of the last 4 quarters, including 2 nice beats in the trailing 2 periods. And Wall Street's also really high on the stock, so 7 of the 10 brokerage recommendations that we have come in at strong buys, with only 1 sell ranking. And then if we look at the stock's performance, the stock has done really well over the last decade. It's up about 460% versus its industry's 52% climb. And then if we look over the last 3 years, the stock's up about 70% versus industry's 4% run. That said, the stock is down about 40% from its early 2021 records. This came after the broader clean energy and renewable energy space pulled back after that massive post-election run that was part of a longer run off those COVID lows. So it was never going to be able to sustain that insane run. So you can now scoop the stock up for 40% below those 2021 records, trading at around $40 per share. And it's currently trading around 50% below its current Zacks consensus price target as well, which is very nice. And it's also trading about 60% below its highs in terms of valuation. It's trading at 21.5 times forward 12-month earnings, which is also right near its 2-year lows. We should also remember that renewables currently account for about 1/5 of U.S. electricity generation, and the EIA projects that the renewable share of electricity generation mix will double by 2050 from about 20% to 40%. So the company stands to benefit from growth in the entire clean energy space. We should also note that its dividend is yielding about 3.8% at the moment, which outpaces the likes of Chevron and renewable energy standout NextEra Energy. And the company's impressive earnings revision activity helps it land a Zacks rank number 2 buy at the moment. And then the last stock we're going to look at today is Huntsman Corporation, which trades in the ticker HUN. So Huntsman Corporation is a global manufacturer and marketer of differentiated and specialty chemicals. The firm operates more than 70 manufacturing and research and development operation facilities in around 30 countries, and it has 4 distinct divisions. Those divisions include polyurethanes, performance products, advanced materials, and textile effects. Its wide-ranging portfolio serves everything from aerospace and defense industries to automation and transportation to electronics, industrial manufacturing, pretty much anything you can imagine. Their chemicals help provide support to those spaces. And the American chemical industry is poised to have its best year in more than a decade in 2022, notwithstanding the ongoing supply chain snafus, according to the newly released mid-year 2022 chemical industry's outlook by the American Chemical Council. So the group projects that total domestic chemical output will rise about 4% in 2022, following about 1.7% growth last year. And if we look in terms of the company specifically, we're expecting over 10% revenue growth this year to about $9.3 billion, and then another 3% growth next year. And then we're calling for big bottom line growth of 27% in 2022, and then another 10% growth in 2023. And this would come after a big bounce back in 2021 that saw the company's revenue climb 40%. And then overall, the company's earnings outlook has turned really positive since its last release. Its current year estimate is up 12%, with FY 2023 up 8%. And then the company's crushed our bottom line estimates in 2 out of the last 4 quarters, and it's beat in all 4 of the last 4 quarters, but it's beat by 19% last quarter and 18% in the third quarter of 2021. And its overall positive bottom line revisions help the stock land a Zacks ranked number 1 strong buy at the moment. And we should also note that its chemical diversified industry is in the top 22% of over 250 Zacks industries. And then, like all 3 of the stocks on the list today, it's pretty highly ranked by the brokerage recommendations that we have. So 8 of the current 12 brokerage recommendations that Zacks has coming in at strong buys, with 1 more buy and then nothing below a hold. And its dividends yielding about 2.4% at the moment, with the stock up about 37% in the last year, which outpaces the S&P 500's 6% decline. And then if we look over the last 5 years, the stock's up about 75%, which is now coming closer to in line with the overall market, which is up about 85% over that stretch. And then if we look over the last decade, the stock's up about 256% versus the S&P 500's 290%. And then in terms of valuation, Huntsman's trading at 7.6 times forward 12-month earnings, which is near its 2-year lows, near its 3-year lows, actually, not too far off its lows over the last 10 years. And this is also marks a 33% discount to its industries, its highly ranked industries, 11.3 times forward 12-month earnings, and 70% below its own highs, actually, over the last 2 years as well. So this comes despite the fact that it's trading just 12% below its records in terms of price at $36 per share. And its current Zacks consensus price target marks 25% upside to its current level. So it's certainly worth considering Huntsman as well as part of a dividend-paying group of stocks within an industries that seem like they're poised to continue to grow amid the current economic turmoil. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.